FirstRand is first.
FirstRand is up. It's a banking, insurance and investment group which includes First National Bank, West Bank, that's on the vehicle financing side, and Rand Merchant Bank, as well as Ashburton.
Which is their private client and asset management operation, indeed.
Market cap 284.8 billion rand, a PE here of 11.9, dividend yield of 4.7%. Can we get the share price graph up just to have a look at how it is tracking of late?
So the sort of shenanigans of government level are reflected there. So in late 2015 you see the Nenegate type scenario, and then in the middle of 2017 here, early days at least, you see the effect of the sovereign downgrade following the cabinet and finance minister shift a couple of months ago.
Look, FirstRand, I mean, as I said, I work for FirstRand, but FirstRand's got the highest return on equity and the highest return of assets of all the banks, and has been there for a while. So you can make the argument it's the best run, for want of a better word. And it's at this, as you see there, the 5-6% dividend yield. However, the problem with FirstRand and all the other banks is they operate in South Africa. You've got low single-digit loan growth. Luckily enough, in the last 3 years, with all the interest rate increases, the banks have been more prudent, so they're not swamped with bad debts. In fact, some of them are releasing bad debts. They are fully capitalized. So you can see with FirstRand and Standard Bank, they increased the dividends by more than what the earnings went up. In fact, you could even say they're overcapitalized. They carry too much money. They haven't spent all their money going overseas and lost it all, so they've done quite well.
But the point that you make about South Africa is an important one, given the ratings downgrade of the sovereign.
Yes,
the banks actually can't maintain. They get downgraded.
But look, understand one thing about rating and junk. It only boils down to one thing, and that's the cost of capital, i.e. interest rates. You can still do business, you can still work, you can still have margin. Just your volume goes down.
Paul, your thoughts on FirstRand?
Just to be clear, do banks need to raise fresh capital when old debt structures roll off, and does that then have to be done at a higher level?
They will do it at a higher level, correct. It will come
so that could compress margins a bit in the future.
But then they just passed it on, because if junk truly, if we get full junk status in South Africa, interest rates in general will go up, which should, look, it's never good news, but it's not necessarily catastrophic news.
Understood.
Well, there we go. Do you want to make a call on this one? We haven't got much time.
Well, operationally, I can see the argument. You know, I'm prone to optimism. So I just think the outlook is a little bit muted right now. So the ratings are about right. So I'm tempted to just say not hot on this one.
Are you
despite the fact that I work there, I'm you know, don't see it wrong. I'm going hot. I think the dividend yield's high. There's no danger to the divvy.
No reason not to buy FirstRand if you're wanting bank exposure.